Good evening, everyone. I'm Tom Kulaga, Executive Creative Director for the New York Times live event series Times Talks. Tonight, we're thrilled to present our first ever Times Talks DealBook event on one of the most important technological innovations in business, blockchain. I want to give special thanks to tonight's sponsor, Accenture. And now it's my pleasure to introduce Wyn Davies, North America Trading Lead for Accenture.
Thanks, Tom. Thank you, Tom. It's always great for me when the firm says, can you come and do an introduction for people who are going to be more eloquent than you? So apologies, I'm going to keep this brief. So as a firm at Accenture, we see the maturing of both cryptocurrency and blockchain as something which is hugely important to the industry. There's a number of questions about how it's both going to serve both the industries that we're going to apply these solutions to, and also meet the needs of all the participants, including the regulators. As such, I'm really interested in hearing the conversation between Chairman Jay Clayton and Andrew Ross Sorkin tonight, and understanding their perspective on this and other topics. Regulation is a key driver for all industries. I work in capital markets. It's huge for us in capital markets. And it's a key topic when we're thinking about what is the future of the industry going to look like, and what is the future of the world going to look like. We need to understand how these technologies are going to be applied. Blockchain and cryptocurrencies are evolving, and we really believe they're going to deliver on their promise. And notice I say promise rather than potential, because we really believe in everything that blockchain stands for. Blockchain has a huge potential to remove friction where multiple parties are reading and writing to a single data source. It's a very exciting time in all industries as people are moving past blockchain tourism, so trying to understand what blockchain actually is, and building real-life production instances of blockchain which are fundamentally changing the way the world works. We at Accenture have been very proud to be in an initiative with the DTCC, who are basically the back office for capital markets, where we tested blockchain and said, can blockchain actually perform and deal with the volumes that the US equity markets deal with, which is it's a high volume test. And we published this a couple of weeks ago. Well, actually, the D2C published this a couple of weeks ago. And yes, it's an unequivocal yes, it can deal with these volumes, which is a huge question. So now we sit there and say, let's move past proof of concepts, let's move into capabilities, and that's what we see the industry is doing. It's really moving there. Cryptocurrencies like blockchain is an area for the future. We're looking in very interesting times. I'm not going to talk about the volatility in the market. I think everybody's aware of the volatility in cryptocurrencies. Sometimes there's a perception that there are too many cryptocurrencies out there. I'm not even going to talk about that. But what we do know is cryptocurrencies is here for the future, and it's not something we're going to ignore. So, without further ado, I'm going to hand it over to people who know what they're talking about and let them talk about and share, because that's who you came to listen to. And Tom, over to you to introduce the panel.
Great. Thanks, Wyn. We are very pleased to present one of the leading experts on blockchain, the chairman of the Securities and Exchange Commission, Jay Clayton. Since taking office in May 2017, Chairman Clayton has been outspoken on securities laws issues related to distributed ledger technology, cryptocurrencies, and initial coin offerings. Moderating tonight's event is Andrew Ross Sorkin, New York Times columnist and founder and editor-at-large of DealBook. He is also a co-anchor of CNBC's Squawk Box and the author of the best-selling book, Too Big to Fail, the inside story of how Wall Street and Washington fought to save the financial system and themselves, reissued this fall on the 10th anniversary of the 2008 financial crash. Be sure to pick up your own complimentary signed copy of Too Big to Fail following tonight's event, courtesy of Accenture. And now, please join me in giving a warm welcome to our moderator, Andrew Ross Sorkin, and our special guest, S.E.C. Commissioner Jay Clayton.
Good evening, everybody. Good evening. Chair Clayton, thank you for being here.
Thank you.
It's a privilege to be here with you. I should say I knew Chair Clayton when he was Jay about 10 years ago.
I'm still Jay.
You're still Jay.
I'm still Jay.
In the midst of the financial crisis. And 10 years later, we have come quite quite far. We want to have really a wide-ranging conversation tonight, and I should say we want to make this as interactive as possible, so we'll open it up later in the conversation to all of you who I know have so many questions. We have framed this around this concept of the blockchain and crypto, and I would make an argument that a lot of that came out of the financial crisis 10 years ago and some of the trust and distrust questions that arose during that period. And so we'll talk a little bit about that. And then I think there's some broader questions about the marketplace that we're all living with today, both here in the United States and throughout the globe. And we should probably have a conversation about that as well. But here's where I want to start the conversation with you.
Actually, can I do my disclaimer?
Yes.
That I have to do? I have two disclaimers. One is my remarks are my own. They're not the remarks of the commission or the staff. And the other one is I'm going to try to speak in non-lawyer speak, in plain language. So the lawyers in the audience, who I may not be particularly precise, try not to give me a hard time. And if I'm too lawyerly, let me know, and I'll try to be less lawyerly.
Okay, fair enough. Let me start here though, and on the crypto front, because there are, every single day these days there's questions about the blockchain. There's questions about Bitcoin. You see the price going up and down and this and that. My question for you is, and one of the reasons I wanted to have you here tonight is, to me, whether you believe it or not, you actually may be the swing vote, if you will, in the future of so much of this technology and how it gets enabled or not, in terms of what the regulatory framework looks like. And so the question I was going to ask is, when did you start even learning about this stuff? Because all of us, so many of us, are still learning about it.
Wow. So let me respond to the swing vote, because I want to give you perspective on how I look at things from the S.E.C's perspective. Our job is not to vote. Our job is to present an even playing field on which other people vote, whether it's the price of a security or not, and to provide a forum where there's disclosure. And that is truly how I've looked at this technology in terms of its effect on the securities market. So that's kind of the perspective. But I appreciate that you want, we want to be fair arbiters of the market rules, and that's how we approach it. But in terms of this technology, let me give you an anecdote. My confirmation hearing, and no confirmation hearing is pleasant because they can ask you absolutely anything. And there were a number of questions. The questions for the hearing was a couple of hours, maybe 3 hours, and the questions went on for a long time. If you search the hearing transcript and all of the questions, you won't find blockchain, distributed ledger technology, Bitcoin, Ethereum. Not a single question in March of 2017. By July,
were you prepared for questions?
I was prepared to say, I'm thinking about it. Which is a good answer to most of those questions.
So what did you do afterwards?
And I can tell you that by July, and I'll give you this. See, my wife is here. My wife always drives, not because I like to read, but because she's a much better driver. We were driving in the car, and I had a stack of documents about Bitcoin, distributed ledger technology, and I can remember a Boston, I think it was a Boston University article, law journal article, or Boston Law. So I can't remember. Sorry, I can't remember which one. It was very good, but I was just trying to educate myself on how people thought of this in terms of our securities markets.
And did you have any initial inclinations about the future of what these things were and were supposed to be? Because even then, by the way, I think people like Warren Buffett were out there calling some of this rat poison squared. And then on the other hand, there were people who were saying this was the absolute future.
And that's why I thought I better figure out, why you have Warren Buffett saying what he's saying and others saying what they're saying. And I shouldn't say just I. There were a number of people at the commission, and I'm very proud of them, who pivoted quickly away from what they were otherwise doing to say, well, how does this new technology fit with the way we approach our securities markets?
So where have you landed? And I'm not sure that you've landed. I don't know if you feel like you've landed anywhere yet, or there's still a lot of work that has to be done.
Well, where I've landed is that our rules and we have kind of two rule sets in the securities markets. One is for the offering and sale of securities, and the other is for trading of securities. And my view is that our rules have stood the test of time very well, and we should not change them to adapt to technology. Technology ought to be able to fit within our rules. And I think this technology has incredible promise for adding efficiency to our marketplace, but I'm not going to change the investor protection aspects of those offering rules or those trading rules just because there's a new technology.
Okay, but then just take me on the journey. I just want to understand it because I think so many people who are here who are interested in this topic are trying to figure out, people look at Bitcoin, for example, and then there's the question of, is it a currency? Is it a commodity? Is it a security? What is it? And I just want to get inside your brain to understand sort of how you've been thinking about it.
So let's start with what's a security, and the folks who came out of the crash and crafted our securities laws, women and men, geniuses, because they understood.
You're talking about the crash of 1929.
The 1929
Yes.
crash. Yeah, the crash before you and I were born.
I just wanted to separate it out.
Yeah. I hope there's no crash on the immediate horizon, okay?
We should talk about that too.
Yeah. I told my kids if there is, it'll be my fault. Just, you got to know that. But they were geniuses. They understood that, here's the fundamental thing. If you're going out broadly and you're saying to people you don't know, give me your money, I'll give you a stock certificate, or I'll give you an investment contract, or I'll give you a warehouse receipt, or I'll give you a token. I don't really know you, but I'll give you that, and you're expecting to get some kind of return from that based on my efforts. That's a security, and we need to regulate it, because that distant relationship and that money changing hands, it's ripe for fraud. It's ripe for abuse. And that's what gave rise to our securities laws. And so we said, if you're doing a public offering in that kind of context where I'm raising money from you and all these people, you got to go through disclosure rules, you got to have financial statements, and that has, look, we've created a $20 trillion economy following those rules.
You used an example recently where you compared the raising of money using an Ico, effectively, to the equivalent of starting a Broadway production and effectively pre-selling tickets.
Yeah, let me, and it goes to your question of when do the securities laws apply, and when has an asset become so distributed, so disaggregated, so out of the control of one person that the securities laws no longer apply and it looks more like a currency. So the analogy I gave was, Andrew, you're gonna start a production. You go out to a bunch of people and you say, give me your money. Production hasn't gotten off the ground yet. Don't worry, I know actors, I know other people, I'm gonna get this going. And what I'm gonna do is I'm gonna give you a ticket or a token in exchange for the money that they give you. That sure sounds like a securities offering, okay? But you get the play up and running, you're done, all the tickets for the next few years have been distributed, they're broadly, you don't control, you're no longer growing the business exists, and then they trade freely. And that's kind of the concept of our securities laws. And if you ask why do we look at Bitcoin as not securities transactions, not a security, it's widely distributed. It was not controlled by a single entity or other people. It's used as a medium of exchange. You're not looking to the efforts of others to increase your return, and that's why. So it looks much more like a currency than a security.
And how would you differentiate that from a commodity?
Well, commodities like gold, silver,
right?
They generally have a use other than a medium of exchange.
And you don't think, I mean, there's some people who just say this is liquid gold, though, for example.
Well, I think they say it's akin to that,
Right.
but you do have an industrial use for gold. You do have an industrial use for cocoa. You do have enough industrial use for sugar or grains or other commodities.
And you think that is that's the distinction?
I think it's closer. Now, people do think it's a commodity, but again, I'm not speaking legally tonight. I'm trying to speak colloquial. That's how we see it.
Well, let me ask you a different question. It just relates to this, though, but it relates to market psychology. So the other thing that's happened during this whole
It's like a currency,
it's like a currency.
right? I mean, it doesn't have a sovereign backing, so it's different from a sovereign currency, but it's designed as a medium of exchange.
Are you a believer? So some people say, Christine Lagarde recently.
And to be clear, I'm not speaking for the CFTC tonight.
Well,
I'm not speaking for the SEC. I'm speaking for something, and I'm definitely not speaking for the CFTC.
let me ask you a different. So recently,
or the Fed, or the Treasury, or any of those other people.
recently, Christine Lagarde came out publicly and said that she could see a time when cryptocurrencies were backed effectively by governments, right? That this could become the future. And so one of the things that I think people wonder about is, if something like that were to ultimately happen, would that be validating of all of these new forms of currency, whether it's Bitcoin or Ethereum or any of these other kinds of things? Or would you think that would ultimately crowd out these things because you'd finally have a regulated version of this?
I think we'll see.
It's a good answer. By the way, I have a question just about your answers. Because I was thinking about the other Jay, Jay Powell, and how everything he says, literally the word, the comma, is interpreted by the public and the markets down to the nth degree. Do you feel the same way? I mean, now that I've known you for 10 years, we haven't gotten a real chance to actually talk much since you actually got into this role. I'm actually sort of curious, just as a person, how that's changed for you.
Well, I think we all at the Commission try not to comment on things that would move markets, whether it's a particular security or markets generally. I think Jay does a great job because he knows that his comments are followed by people in the markets. And I think that's a really significant responsibility that he has. I try to stay away from anything that's going to, I won't comment on a particular company or a particular stock. It's just not appropriate for me to do so.
Okay, so let me ask you this, and it does relate. We use Bitcoin, but we'll use it as a proxy for this portion of the conversation. Because you do think about markets, and you think about the public and public shareholders and investors in the public at large. Mm-hmm. How do you think the both bubble up of Bitcoin and the price and the hysteria around that, and the drop down over the past 12 months has affected market psychology and trust? Because this goes back, it's funny, Bitcoin and so many of these distributed kinds of cryptocurrencies were ultimately about sort of creating this sense of distributed trust, but in some ways, some of that trust has become undermined, and I wonder how correlated or uncorrelated that is to the markets and also just to the broader sense of public investor interest in any of these things, and how much you think about that.
Well, let me say how I think about it, but it's also how I think the people at the Commission think about these things. Look, the markets have a lot of sophisticated players, a lot of complexity, literally hundreds of millions of transactions a day. But at the end of the day, we're running these markets for the long-term retail investor, whether indirectly or directly. I mean, our capital market system should be run for those folks, the people who are putting $100 a month, $200 a month into their 401k for 30 years. It's their money, their long-term money, that fuels all of this. So, when something like this happens, the lens at the Commission is, how do we deal with this with those people in mind? And I can tell you that, very quickly, very quickly with crypto assets, we tried to get the word out that although the trading looks like the trading you would see on NASDAQ or on the New York Stock Exchange, these markets do not have the same kind of safeguards for you. We've worked for 50, 60, 70 years to try and prevent manipulation in those markets, to try and prevent people from taking advantage of the small player. It's what we do, but the markets that these things originally traded on, they didn't have those safeguards. And I made it also clear to people that if you're sending your money offshore and something goes wrong, there's very little we can do to get it back as a practical matter.
Well, so let me ask you about that.
And I hope people heeded that. I hope they didn't use their credit card to buy some kind of offshore token without really, really, really thinking about it.
What do you think has to happen from your vantage point for a Bitcoin or an Ethereum to actually be a regulated, or whether you think it, well, I imagine you think it ultimately has to be regulated, but what would have to happen? Give me your sort of 5 years out, what's supposed to happen if this is supposed to be a real thing?
Look, I think what is the use case? What's the permanent use case for anything, right? That's how you look at an investment.
That would suggest that that actually 5 years from now we wouldn't necessarily be talking about this, because we just talked about how a commodity, we could say, is a real thing. Unless you're saying you think you're.
You asked me where something is in the future. Look, I'm going to be philosophical with you.
Okay.
Okay. Well, I think you know that I love markets. You know that I love ingenuity. One of the and I'm not going to take credit for this, but one of the wonderful things about America is, if there's a new technology, we pour an incredible amount of energy and capital into it, and it's a race to figure out what the best use for that technology is. And there are lots of failures and there's some successes, but anybody who predicts with certainty where that race is going to end and who is going to emerge, I want to meet them, because I can tell you that I thought, I'll say this, because I thought that what was it, Webvan?
Yeah.
Thought Webvan was going to be a great idea, and Amazon was not so smart. That shows you how good I am, right? But there was this incredible race to use data and information to provide delivery. Webvan, does anybody remember Webvan besides me? Yeah,
I remember.
it failed.
Right.
Great idea, failed, and Amazon, similar idea, different space.
So
great success.
So where do you put this space? And but I guess what I am asking though is, in terms of if you were an investor thinking about this space, the crypto space, and specifically the currency space, let's call it for now. Let's take Ico's out of it for a second.
Well, now you're out of my regulation, right? Why don't you take it out of the security space?
That's true too. Yeah. But just
Yeah, no.
play along with me for a second here. What do you think has to happen for it to become truly popularized? And by the way, I'll turn it around. If the Winklevoss twins, for example, wanted to have an ETF based on some of this stuff, it would be back in your space.
That's true. That's true. And that's a different conversation that we can have. Andrew, I just don't know where it goes. But going back to what we started with, I want to try and be clear and fair and apply our rules to this new technology in a way where we're not picking winners and losers, but we're protecting investors.
Let me ask you a different question then around blockchain, the technology, because I've seen you make lots of comments about, on the infrastructure side, how you think that's actually going to be a very important component of the future of business.
Well, going back to your question on trust, one of the promises of this technology is that it adds efficiency to the trust issue. So, we have government records, and we spend a lot of money, recording and making sure that they're accurate and that they're immutable and all of those kinds of things. And this technology has great promise to deal with that.
What do you think of the idea that so much of this technology ultimately is actually about not only being distributed, but actually having no real arbiter? The arbiter, if you will, if you really understand the philosophical underpinnings of much of this technology, is that there is no arbiter, there is no judge, there is no jury. Everybody who's participating is that. And that one of the reasons it actually hasn't taken off.
That's a real issue, okay? Because if you look at our securities laws, and I'm getting more, and I'm staying in that space, but I'm getting more sophisticated, they do assign responsibility. A company has to produce financial statements. They have to produce disclosure. If they don't produce it, they have a problem. If it's materially inaccurate, they have a problem. If you have an investment bank that acts as an underwriter and there's a problem, they're responsible. Accountants, they have responsibilities. We've set up this system of responsibilities. We almost take it for granted, but there are people who have responsibilities. If you're going to distribute an ecosystem and say, no one has any responsibility if something goes wrong, well, heck, nothing better go wrong.
Do you think, and I think it was just earlier this fall, maybe in September, I think Congress sent you a letter saying how should all of this be regulated. Do you think that Congress will ultimately have to create new laws for this world?
I think we'll see. I think the securities laws do well in securities offerings. I think my friends at the CFTC feel comfortable with their laws to the extent we have digital assets that don't fall within either, and they begin to have substantial use, maybe. But there are laws that apply to crypto assets that go beyond the securities and commodities laws, including anti-money laundering laws
right.
and terrorist financing laws and all of those kinds of things. There are other laws that apply. Go ahead.
I was going to say, you mentioned the CFTC, and one of the things and it almost feels like sometimes the SEC gets pitted against the CFTC in this regard. The CFTC has been very aggressive about being behind, or maybe ahead, I should say, in terms of being, I don't want to say promote crypto, but I would argue that they've sort of gotten behind this in a real way. Do you feel any kind of competition between the groups?
Actually,
do you guys have conversations about this stuff?
Oh yeah, no. I feel very good in this job that I can pick up the phone and call Christian Carlo at the CFTC, or call Randy Quarles or Jay Powell at the Fed, or Joseph Otting, or folks at the Treasury, if there's something like that I feel like
right.
There's an inconsistency in the way we're approaching things.
So, but you know that Christopher used to do #CryptoDad on Twitter. Do you know about this?
Yeah.
And so, what did you think of that?
I don't have a Twitter account.
We got to get you one. There's some other people who you may know who have a Twitter account.
I said that was easy, wasn't it?
Touché. Let me ask you this, because it does relate to sort of the advent of ICOs, but I think it relates to a larger issue in this country right now, which is that so many entrepreneurs out there say they don't want to be a publicly traded company, or they don't want to go through the ordinary publicly traded process, if you will. This is James Freeman. He was the founder of Blue Bottle Coffee. I don't know if you saw this. He sold his company to Nestle, and when he was asked why he didn't pursue an IPO, he said that he thought an IPO seems like a way of living in hell without dying. And I thought that was sort of a fascinating way to think about it. I think it speaks to the crypto thing, but I think it speaks to a larger issue in the marketplace today, and I want to know how you thought about that right now.
He's, look, he struck a chord, and he's not the only one who feels that way, and the numbers don't lie. We've gone from 8,400 public companies to just over 4,000. The size of company that you see entering the market is much larger. Right. Companies would go public much earlier in their cycle. I believe there are multiple contributing factors to this, but we need to look at them. And one of them is, are we? I'll try and give you these stats. I think I know them. Top company in the S&P 500, then like the 100th company is, it's 40 times less. Then we go to halfway down the S&P 500, we're at 100 times less the size, and it gets down to 200. 1/200th. You probably should not regulate 1/200th, much less 1/1000th of the size company the way you do regulate the top company. I think that's, we need to think about that a little bit. Another metric I like to think about is, you've got a decent sized company, well run, and it's a public company, and how much time in a quarter does the management spend on compliance and dealing with regulation and performing that function? It's probably somewhere between 20 and 30 days out of the 90. Or maybe it's 15 in a place that's doing it very efficiently. If you look at a similarly sized private company, that number is probably 2, 3, 4, 5 days. Well, think about that in terms of competitive advantage for the private company. They've got another 20 days, 15 days where management can be devoted to the business versus compliance. I ask myself, can we fix that without in any way impairing investor protection?
So you ask yourself, and how do you answer the question?
Well, we're working on it. We have a regulatory agenda that we're trying to get rid of the things that we require companies to do that don't go to investor protection and that don't go to material information. And we're looking at that. And look, our securities laws have been so successful. I mean, there's problems, but they've been so successful at contributing to this economy, and they're so effective. Like, if we tell a company, you've got to disclose this, they usually do. I mean, think about that. And so people have used that to add things to our securities laws over time without in any way taking something away. So I'm trying to look at it and say, are there things we can do to streamline this, making sure we're not doing anything to take away and hopefully enhance what we give to investors, but reduce the burden.
Did the size of the company matter to you? Meaning you were talking about how there might be certain types of regulations that matter for a large company, but that you don't think then should be applicable?
Well, I mean, I'll just, look, I'm speaking for myself,
Right.
but you have a multinational company that has a number of subsidiaries. The kind of, what I would say is compliance and reporting process that you should go through on that company should look far different from a monoline company that only has operations, in the Midwest.
Okay, I'm going to make it more complicated, though. You just recently made some very interesting and outspoken comments about disclosures for companies related to Brexit. I know this is an issue that you care a lot about, and I think you're worried a lot about.
Yes, I am. Yes, I am.
How do you think that companies that are exposed to Brexit, does it matter whether you're a big company or a small company in terms of what you're supposed to tell the investor?
It matters how much of an effect you think Brexit is going to have on you. The threshold for disclosure is this a material event for the business? I mean, that's the general threshold. Is this something that we think is going to affect our business in a significant way? But let me go to Brexit. What I'm seeing in disclosure by companies is companies in the same industry. Let's pick it. Let's put pharmaceutical. Companies in the same industry. Company A has a similar footprint to Company B, and Company A's disclosure is, you know what? This could hurt our supply chain. This could hurt our distribution. This could hurt these things, and Company B isn't really saying anything yet. What I said to the marketplace was, hey, to the extent you are thinking about this, at a high management level and in the boardroom, think about telling your investors about it, because this is one of those things. If you look at Mark Carney's comments, the range of possible outcomes for the economy from Brexit is very broad, and the bad end of the spectrum is pretty bad. And to the extent companies are preparing for that, or they should be starting to tell their investors about it.
So you don't think right now you're seeing enough companies?
And I don't, look, if I were, a year ago, Brexit was still on the horizon. There was, I think, a fair amount of expectation that it would not be a hard Brexit, that this would get worked out, that there wouldn't be, lines at the border or uncertainty about whether contracts could be enforced or some of the more dramatic things. The risk of that has gone up. So if I'm running a company that has exposure to that risk, I hope they're thinking about it, and I hope to the extent they see it as material, they're disclosing it.
How much do you worry, by the way, that investors, and now we're moving a little bit away from crypto, but how much do you worry that investors see these cautionary statements about potential problems down the road, but look at something like that and literally gloss over it because they say everybody's going to have what's going to look like boilerplate in their filing, and therefore it doesn't take on the significance that maybe it should?
I think, Andrew, that is a fabulous question because in this case, I don't think it should be boilerplate if it's significant. And one of the hard things about something like Brexit is it's hard to see all the effects or potential effects until you go out and ask all the people who may be affected by it. Like, I doubt there are, let me put it this way. I am sure there are effects at companies that company management is thinking about that the people negotiating Brexit have not thought about, that may be significant. Because, we all focus on our own agenda.
While we're on this topic, President Trump tweeted earlier this year, and then I believe sent you a letter directing the agency to look into how to create companies or how to push companies to think more long-term. In fact, he had this idea, I think he was whispered in the ear by Indra Nooyi from PepsiCo at the time, who recently stepped down as the CEO of that company, that maybe they should only have earnings reports twice a year. And I know you're looking at this as an issue.
Okay,
What's happening?
So look, the president, I think he struck a chord, and he said something that I think is important, which is if companies are being run too much for the short term, that's not a good idea, right? Most investment cycles for a company are 3, 5, 7 years. You're hiring with the expectation that the people will work there for a while. You're investing in plant, property, equipment with or intellectual property with the expectation that it's for a while, and running your company quarter to quarter to the exclusion of that, not a good idea. That said, our markets thirst for information. They thirst for quarterly information. All credit agreements require quarterly information.
So what's the right balance?
So the question is, how do you get people comfortable looking beyond the quarter as investors? Easy question to articulate, hard in practice. One of the things that's interesting about our disclosure system, is it's a backward-looking disclosure system. When you report last quarter's earnings. You talk about how you did. And the outlook section or the outlook part of reporting is generally fairly narrow. It's the way it's evolved over time. And that quarterly guidance that some people do, and that's up to them whether they do it or not, that becomes a very important number because it's sort of one of the few forward-looking data points. The question is, how do you encourage people to look beyond that one quarterly data?
But then this goes back to people, by the way, with their Icos, and they're trying to sell you on the future. How do you actually tell people? It almost seems like you're suggesting that actually we should have more forward-looking guidance.
Or more forward-looking information, but back in my lawyer days, I will tell you that everyone was always cautious about giving too much forward-looking information for fear of liability.
For fear of liability and for fear of missing, for fear that your guidance is going to turn out to be wrong.
Yes.
So what's the answer there?
Phone a friend? No. No. Look. I think I'm not going to. There are companies that are very good. Let me be very clear. There are companies that are very good at charting a direction, updating that direction, and getting investors comfortable with that longer-term direction and their ability to achieve it. And I hope that the way we regulate companies encourages that kind of shareholder communication for the longer term. And I am looking for suggestions on how to amend, change our system so that we can foster that kind of conversation in a way that provides investors with better disclosure while at least maintaining and hopefully enhancing the protection they have.
Right.
That's what I'm looking for.
I'm going to open it up in just a couple of seconds, or just a couple minutes rather. Couple things though related to the company formation, and it goes back to this whole idea of an ICO. By the way, how many people here don't know when I say ICO? They're like, what is an ICO? Anybody? No, everyone's up on this? Wow, I'm very impressed.
Where were you in March of 2017?
You're with him. You want to explain what this is all about? And by the way, I saw just before we got here that you actually had some comments about Floyd Mayweather and ICOs. Do you know what I'm talking about?
I don't know about any comments I made, but you mean the SEC, the agency?
The agency that you work for.
Yes. No, we had a settlement today with Mr. Mayweather, and
for promoting ICOs for a particular. Explain for those who don't know what an ICO is.
Okay, I will say it this way: assume an offering of securities that is styled as a token or coin offering. What happened was, in effect, people who were raising money issuing tokens or coins as securities, like we talked about, like to start a production company or do something like that, did not comply with our securities laws. There are two ways to do an offering of securities like that. One is a private placement, and that's where you go to a smaller group of qualified investors and sell them the securities, and they generally are not able to trade them except among themselves with certain exceptions. Or you do a public offering, like you see in an IPO, where you can go broadly. But when you go broadly and promise people liquidity in the secondary market and the ability to get out of their investment and sell it to somebody else, you have to register with the SEC and provide disclosure and take responsibility for that disclosure. Well, many ICOs basically wanted the benefits of the private placement market where you don't have those financial statement disclosure requirements, and the benefits of the public market where you can distribute it via the internet and broadly and whatnot. And that's just inconsistent with our system of investor protection and confidence. And so many of these ICOs were non-compliant with our securities laws. Did I get that right?
You did a great job. Okay. I have a couple just real quick questions, again, sort of broader market questions, but related to the creation of companies and what's going on in the public markets right now. So one of the great debates right now in the public markets, I think, is the idea of control shareholders. Mm-hmm. I'm thinking, by the way, you don't have to speak to Facebook itself if you don't want to, but of Mark Zuckerberg, who's right in the news right now, where you have a company where shareholders are effectively along for the ride. They don't have control of the company. If we're being fair, by the way, we're sitting here at the New York Times. The Sulzberger family has control of the company. Do you think that that phenomenon, which used to, by the way, be related mostly to media companies that were trying, frankly, to be able to protect the journalism, makes sense in a broader context? Because I think people are looking at some of these, especially some of these Silicon Valley companies, and raising some questions about that.
So two things. One is that issue has, for a long time, been an issue of state law. Corporate governance has some federal SEC aspects to it, the proxy process and whatnot, but voting and the rights of shareholders is predominantly a state law issue. People have asked us to get more involved in it. Exchanges have gotten involved in it in the past by requiring companies that want to list on the exchange to have a certain type of governance or not governance of the type you talk about. I am going to speak just for myself. There are some people who believe that every company should be one share, one vote, and there are some people that believe you can have any governance model you want. It's a matter of contract. I am much more in that one share, one vote only extreme doesn't make sense. There are companies for which I would much rather have the control be in a founder. And, to say that, in perpetuity, somebody who might not have skin in the game, no economic interest in a company, but still control of that company, that doesn't make a lot of sense to me. Where we land between those poles, is a matter of discussion, but I'm not a devotee to either one end or the other of the spectrum.
Okay, I have 3 more questions, and I promise I'm going to open it up. One is, I was watching you on TV earlier this week, and you were asked a question about a tweet from Elon Musk, who you had a settlement with earlier this fall. And right after the settlement, he tweeted out, he called the S.E.C., he said it was called the Short Seller Enrichment Commission. That was that was after the settlement. And you were asked about this, and you looked at the reporter who asked you the question, and you looked as if you had never heard about the tweet before.
I have a sarcastic side to me.
So what did you think when you saw the tweet?
Look, that matter's settled.
See, now you're reverting to the lawyer part. You must have had a thought. Are you on Twitter, by the way? I mean, I know you're not publicly on Twitter, but do you have like a Twitter account?
Can I access Twitter? Yes.
I mean, beyond just going to the Twitter website and searching, do you have like a secret name or something? Handle? He's a lawyer. Okay. The great part about doing live journalism, unlike when it's in the paper, is you have to get a no comment in the paper. You just saw the answer, everybody. Okay. Let me ask you two other questions.
This list gets longer and longer.
I know. One is just a critique that I just wanted to ask you about, which is, and this is actually a critique that's been, that I get asked about as well. This is post-financial crisis, everything else. There's a lot of people who say that there was not enough accountability after the financial crisis, as you know. And in the past year, there's been other questions about whether, and this is a public policy question actually, about whether the S.E.C. and other parts of the administration aren't holding the business community to account in the same way that as much as they should hit. And I was curious actually if you just address that.
So we have an enforcement division that is run by former Securities task force
Stephen
head
Pekin
here, who you know, and Stephanie Avakian. Then around the country, I've been very lucky. Had a lot of really strong prosecutors join us, and they have a pretty general direction from me, which is we need strong deterrence. I want to get investors who've been wronged their money back, and I want bad actors out of the market. It's a privilege to work in this industry. If you work in the industry, you make a lot of money as a general matter, and if you're a bad actor, you shouldn't be there. And I can tell you that on those measures, I'm extremely satisfied. On other measures, I will, all I'll say is that some of the criticism you see of, and I'm only going to speak about the S.E.C., some of the criticism you see, if you used that type of analytics as a company, we would investigate you. But I will offer one metric, and that is money returned to investors in 17 and 18 are the highest years.
Really?
Now, some of that is the work of my predecessors because it takes a while, and let me give them credit, but that's a very important metric.
Okay. Final question, I'm going to open it up. Do you have any idea who Satoshi Nakamoto actually is?
So when did you start? No.
By the way, do you think has the S.E.C. ever tried to figure it out?
Not with any success.
Okay. No, I was actually really curious.
No.
Let's open it up to questions. I know there's probably a lot of people who have thoughts, and I know we have microphones. You know what we're going to do? We're going to set up the microphone. So if you have a question, rather than raise your hand, we're going to, if you could make your way to a microphone, I think that'll actually be the easier way to do it, but hopefully there won't be a rush all at once.
Do I get to pull the female card and be first?
Absolutely.
Great. So
They say that Satoshi, by the way, there's a group called Satoshi as a female. They sell T-shirts.
I have stayed away from the whole conspiracy theory thing for a while. So my name's Grace Schroeder, and we are a technology platform working with people, issuers, transfer agents, broker-dealers who are striving to start to issue security tokens. And one of the things we've been doing is working with attorneys to try to craft the disclosure language to accurately depict how a security token complies with existing SEC regulations. In some circumstances, it becomes kind of a belt and suspenders. For example, something really simple. You're starting to see some of these Reg A filings come in saying, well, it's incumbent on the transfer agent to make any transfer, because they're sort of presuming that the transfer agent has to perform some of the duties that are now actually accomplished by the smart contract itself. So for example, the smart contract can prevent the trading of a Reg D security for a year. The smart contract can make sure that a security is not transferred from an investor that's passed KYC through to one that has not.
Know your
et cetera.
customer, by the way, that's just, okay, I'm just translating.
So
So it's tough because what we're sort of, the attorneys I'm talking to are sort of saying, well, just to be safe, let's put in the disclosure that the transfer agent has to do anything, but it's kind of a useless exercise because it's.
do you mind if I try and frame
Yeah,
this for the
hit it.
audience? I think, I tell you, what you're referring to is that in the world of private placements of securities, which I think is what you're referring to, we have essentially restrictions on the transfer of securities, and it's to protect investors. Our securities laws and practice placed responsibility for ensuring that the transfers were appropriate on a transfer agent. And I think what you're saying is this technology is such that the need for a particular person to validate those transactions may no longer be relevant.
Correct.
And you're essentially saying to us, hey, since we're achieving the same objective, why do we need this person?
Exactly.
And it's a valid question. It's the way we should think about it. Now, the question would be back, like I've asked, is, okay, if something goes wrong, who's responsible? We may have the transfer agent in this case, but we have set up a group at the commission to deal with these questions. As I like to say, we're open for business. We have a person in charge of crypto, Val says panic,
Yep.
but we have our FinHub, and I would invite you to please come see us. I hope if you have, you've gotten a good reception.
I have tried and have been unable to, and so what I understand is it's easy for attorneys to get in there, but not so much technologists who are trying to align, because with our platform, we can actually align the exact process with the exact reg, and it's just kind of a nuanced questions that we could get answered.
I'll organize a lunch for you.
You
and
will?
We'll get everybody to
Okay,
I
I'll
got
hit
it.
you with that. Thank you. Appreciate
Thank you.
Yeah, at the beginning of your presentation, you mentioned about the blockchain is a technology, and you don't want, for example, our security laws to adapt to the new technology development so fast. But actually, in my mind, I think blockchain itself is more than a technology. So if you talk with the founder of the Ethereum, Vitalik, he mentioned actually a keyword which I like very much, is he mentioned about the blockchain is more like a mechanism design. So the token itself, why the token is so popular now is actually it's a mechanism design. It's a new design of our capital markets. Why, the reason behind is if we look at our current capital markets, the corporation goal is to maximize the shareholder value. But in the token, if you have a very good token design, the goal is actually to maximize the stakeholder value. So actually, because of the blockchain technology, it led us to revisit the corporate social responsibility. So do you have any comments from this point of view?
I think what you're saying, and you can tell me if I have this wrong, is that the model we have now is a principal agent model where the principal, the owner of the company, is the shareholder. The agents are the board of directors. The responsibilities to the shareholders are defined by state law, fiduciary duties of loyalty and care. And that what people are advocating is that through tokens and the way the rights of the token holders are structured, you can have a better principal-agent relationship. That's a lot to swallow based on a model that we've had, but I get it because, look, You know, there are closely held companies that have much different suites of rights among their shareholders than your typical public corporation. But as I said to Andrew before, I'm not going to guess where this comes out in terms of, you know, the solution to the age-old principal agent problem. But, you know, we'll see how the market.
All right, thank you.
So you said tonight that the law should
I'm always
not-
nervous about questions that start with "you said."
Yeah, this one's
My
harmless.
16-year-old's really good at those.
Right. So you said that the law should not adapt to emerging technologies and that the technology should adapt to the law. But
That's not quite what I said, but we'll go with it.
it's pretty close, I think. And I feel like that sort of intransigent view towards law has gotten us in trouble before, with net neutrality serving an unprepared approach to net neutrality serving as an example to that. So I guess what I would ask is, can you offer an example in which this approach of allowing the new emerging, potentially disruptive technology to adapt to the law and not getting out in front of it with laws and regulations has been successful?
So, you know, most securities trading today is digital. There was a time, and there's people in this audience who were there, when at the end of every day, you had to take a stack of bonds and take them back to the vault, and everything was done by paper. Now, almost all bond trading and stock trading is done on a digital basis, and that the law of, you know, who's responsible and investor protection hasn't really changed. I mean, we process literally, I mean, you probably know better than I do, but hundreds of millions of securities transactions a day because of the digitization of our markets. I expect, well, and there was a time when you had to deliver investment materials, you had to deliver them by paper. Today they can be delivered by the internet. I expect that over time, distributed ledger technology will become part of the market ecosystem. What I'm not willing to do is I'm not willing to say, you know what, if you wanted to raise money in a public offering, you used to have to give people financial statements and you used to have to you know, take responsibility for the disclosure, but this technology is so good, we're going to get rid of that protection. I'm just not going there. So I hope that answers your question.
Sure. Thank
Thanks.
We only have time for a couple more, but go ahead, sir.
Chairman Clayton, thank you for coming to New York and showing up at this event in Consensus Invest this week. I had just one question. If you're a blockchain startup and you file a Reg D or a Reg S or an A+, do you foresee the tokens being a securitized token in 2019? And I'm appreciative that FinHub has launched, but if you've been around for 5 years and you've pre-mined billions of coins and you're talking to Coinbase and Gemini and Binance, but you can't cross that threshold to be legal, do you foresee 2019 as that point for a company to launch a securitized token?
You know, I would love to be able to give you a simple, specific answer right now, but like I said, we are open for business. A lot of this is facts and circumstances dependent, and I do hope you'll come down or connect with our corporation finance department.
I'm in the process of doing that.
Okay, thank you.
Thank you.
By the way, what do you think just broadly of the exchanges, of the crypto exchanges, and what kind of regulations they may ultimately need for this to all work out? How about we put it just in a very broad way like that?
I'm going to say it this way, Andrew. If you are exchanging securities, you have to register with us as an exchange or have an exemption. And we've recently brought actions to say you can't just, you know, act like a securities exchange and not follow our rules. Okay? But I also wanted to make this clear to folks. To the extent you see these kind of crypto exchanges operating offshore, the prices and the trading may look like what you would see on a regulated securities exchange here in America. Your expectation should be that it doesn't have any of the safeguards, or I shouldn't say it, I shouldn't be so dramatic, that the safeguards are not of the same caliber and in fact materially different from the safeguards that you have on trading on exchanges as we know them. Look, I'm a patriot. I was a patriot before I took this job. I'm even more of a patriot now. Let me throw a stat out. We have 4.4% of the world's population. We have 52 of the top 100 public companies. The standards that we set for how our markets operate essentially become adopted by other places. I mean, I feel a great responsibility to keep that going, because we've truly gotten this pretty right. I mean, made mistakes, things wrong, but as far as like the standards that we've set, I mean, pretty good.
Hi, thank you, Chairman, for coming here. Is it possible that a token that's sold in compliance with securities laws as an investment contract at a later date morphs into something that's not a security? And if that's possible, can you elaborate what are the circumstances around that?
I do think that's possible, and I do think my production example is if Andrew sold me the right to 1,000 tickets, that right feels like a security because I invested in his production with the right of getting a return. I hope his production works. I hope those tickets become very valuable. I hope to sell them in a secondary market. That sure seems like a security at the time, but once the production is up and going and, and I have those tickets, they're pretty much a ticket to a show. And I know that, may not be the most satisfactory answer because it doesn't give you an absolute bright line. But in this area, it's difficult to give you a bright line. But I hope that gives you a sense for when something that started as a security and a right in an enterprise becomes something that you use as a token.
Let's sneak in a couple more. Let's take a question over here and then we'll.
Hi, so I really appreciate your concern for investor protection. And by the way, I'm a technologist, and I believe that the law is broad enough that technology can actually fit in. My question is I'm curious about, there's another player in the market, and those are the innovators. Those are the next generation startup founders who are sometimes actually moving out of the US because they feel that some of the regulations are too burdensome, right? So I can see your role as you're trying to balance investor protection with the concern for these innovators, but I would love to hear more about how do you draw that balance?
So I'm really glad you asked that question because there's more to investor protection than just, eliminating all risk. Because if investors don't have ventures and new ventures to invest in, that's not protecting them. That's basically saying you got to go somewhere else to get exposure to new ideas. I don't want that. I don't want people to feel they have to send their money offshore or to some unregulated market to get exposure to those things. People may call it a balancing. I don't call it a balancing. I think you're trying to achieve both. And I want to bring some of those technology companies back to the ordinary investor. I worry that our ordinary investors do not get exposure to companies until they're very mature. So I thank you for your question, and I think that, you should just know that that's on my mind as well.
Thank you.
Great. Go ahead, sir.
Hi, my name is Rodrigo Seda. I'm an attorney at a blockchain boutique. Thank you very much for your time. My question relates to regulatory arbitrage. I think you have highlighted even tonight that you believe that this technology has a lot of benefits, and you've also highlighted that it's global in nature. So I'm wondering, as you look at other jurisdictions, is there anything that you see in other jurisdictions that you think are good implementations? And a second part to that question is, do you worry about the US regulation being too strict in America, missing out on some of these developments? Just anecdotally, I think lawyers in this space have seen a lot of Reg S work, but not a lot of domestic issuances. So is that something that's on your mind? And how do you think about that?
So yes, it's very much on my mind. I've had a lot of dialogue with my counterparts around the world through the FSB, the Financial Stability Board, and IOSCO, the International Organization of Securities Regulators. Do I think about issues like regulatory arbitrage and whether we are, as I've said to the questioner over here, as a result of our actions, forcing good opportunities out of our marketplace? Yeah, I do think about those things. But I can't tell you when I go to those places, let me put it this way. The value of a US compliant offering, whether it's a private placement or a public offering, a listing in the US, it still has tremendous value. And it's important for us to maintain that. And I think about that all the time. There are people who do a lot of things to try and get that good housekeeping seal of approval. So that's how I think about it.
Thank you.
Why don't we sneak a couple, maybe this one and this one, and we're going to sneak all three in, and we'll just go. We're going to go very quick, though.
You're a pleaser.
I try. Rapid fire, though.
Gentlemen, thank you. Tonight's date night for my girlfriend and myself. We're both blockchain consultants, and this was excellent, by the way. Anyway, I like your analogy with what you would look at with the Lindy effect, essentially. What you discussed before with the Broadway play example. Some people would say that, like, say, The Lion King, which is right around the corner from here, which has been around for over 20 years now. Basically, the longer that something is around a technology within society, the more likely it has of a chance to survive. So Bitcoin has been around for over 10 years now. So if you were to look at from a staying power standpoint of what is most likely to survive in the long run, especially because there's only 21 million in human history that will ever be minted. So what do you think in that respect? Do you think that your characterization before and your example of, like, say, what was it, Webvan versus Amazon, it seems like that might not have been a great comparison.
Unfortunately, I've been involved with a lot of the failure of a lot of historic companies. So I'm not sure that longevity is always a indicator of future success. But I get your point that, I made the analogy before that one of the things that's amazing about America is a new technology, new promise. People throw themselves into it with more capital than maybe makes sense. But they do that in large part because they understand being the use case that is adapted has such a huge return. And it's one of the great engines of, kind of the American economy. So I agree with that. But whether a specific, I'm not going to comment on whether one or another, but that characterization I agree with.
Thank you.
Ma'am.
Great, thank you. And thank you both for being here tonight, and Chairman Clayton for your candor. My question relates to the ETF and the multiple ETF proposals that have been proposed to the SEC. Most of them, according to I think most of the press that's been out there, have been rejected related to market manipulation aspects related to the ETF and information sharing. How much of that concern is related to offshore exchanges and price movements related to jurisdictions outside of the SEC? And should that have been something that is really regulated within the U.S., is that less of a concern, or is it really because there's so many fragmented markets in this space?
So let me try and cast your question in a way that captures the regulatory issues, and that is if you take a commodity like gold and you put it into a vehicle and then you sell interest in that vehicle like an ETF, say, hey, here's my ETF, buy shares in this ETF, and it either has gold underlying it or maybe gold futures or something. And you sell it, you're in, and I'm being general, you're generally creating a retail product, a product for retail investors to participate in. And when our retail investors participate in a securities product, and that's a securities product, they expect a couple of things. They expect good accounting. They expect good custody, that the underlying asset, the gold or the futures in gold, is going to be there. And they expect that the price they get when they sell the ETF or buy into the ETF is a good price. And that is that it's been set in a way that they can be comfortable with. And when we look at these types of things, we ask the question, is that pricing on which that ETF is based, is it subject to manipulation? Does it feel like a good price? And can we be comfortable that the asset is there? And that's the kind of examination that, and there's other factors, and we have a lot of smart people who think about these things, but those are the principal things that we've been thinking about with respect to ETFs in this space. Is that clear?
Yeah, my question was really related to jurisdiction. Does the fact that there's so many exchanges offshore really affect that decision making within the SEC?
I think your question is, when we look at, say, is the trading in this such that it's not easily manipulated, or the risk of manipulation is sufficiently low? It's not necessarily jurisdiction, but it's how comfortable can we get that the rule set that applies to that trading is good and enforceable. Rules are great, but you got to be able to enforce them. You can have the prettiest set of rules, but if you have no enforcement, they're not so good.
Okay, thank you for the question. You're the finale.
Thank you. Okay, I'm not sure who my question would be best directed to, but I work for a boutique entertainment accounting firm where we work with big studio films, and they...
Hollywood accounting?
Sorry? Yeah. We were recently contacted by Singular DTV, which was described to me as on the blockchain, and I'm just curious how we deal with multi-currency shows all the time, but what would working with a company that is, so to speak, on the blockchain mean for us?
Ooh. This is a tough question.
I think Gretchen's going to have to drive me around the block, and I'll do some more reading.
I'm afraid to say I don't know the answer.
Worth a shot.
Okay. Thank you for the question. Everybody, thank you for the questions. Thank you for being here. Thank you to the chairman for a great conversation. Really appreciate it. Thank you so much. This is great. Thank you.